Hello, everyone. Welcome back to Earnings Call. My name is Jeffrey Beamer. I'm the Senior Investment Strategist over at ewotrader.com. And if you've been with us for a while, you know we don't just talk about stocks. We don't just talk about options. We talk about how to use options around company earnings announcements. All right. So this week, the week of May 18th, 2026, is centers on two market-defining themes: AI leadership and consumer resilience. With earnings from semiconductor name Nvidia, that really headlines the week, but major retailers are likely to drive the index and market volatility this week. Okay, so Nvidia headlines the week, and traders will they'll key in on AI demand, the company's commentary, their margins, especially forward-looking guidance. And with these results, we dive into the retailers. The retailers also move into focus this week with Home Depot, Target, Lowe's, TJX, Ross Stores, Walmart. They're all up to bat this week. So we're going to go through the list, take a look at the best potential candidates, along with trade updates from last week's trade. And I got a new opportunity for you today, all coming up right now. Okay, everybody, as you know, we do talk about a lot of stocks. There is a chapter feature at the bottom of this video, so you can jump to whatever you want to look at. But we have our list of stocks that are broken up into two halves. On the left-hand side, you have what we call our breakout stocks. These are companies that consistently move double digits around earnings. That means 10% or more around their earnings announcement, okay? Usually post-earnings announcement. The stocks on the right, that's our quiet list. These stocks move less, they move single digits, okay? So less than 10% through the earnings announcement. And some of these actually move less than 5%. So we call these quiet stocks, okay? And we go through these lists, we analyze, we do different strategies for the breakout stocks, then we do the quiet stocks. I'll talk a little bit about that as we get into it. But let's take a look at our list. Well, you already see it on board, but let's start with the quiet list. All right. Let me give you an example of what a quiet stock looks like. This is Pfizer. Now, Pfizer had earnings a couple of weeks ago, but I do like to show the chart because this is just a common quiet stock. It moves single digits, actually about 3% through earnings. It's just not very volatile. Okay. And it's just not very volatile really at any time. And especially around earnings. For these stocks, we like to do a strategy called an iron condor. And this is simply selling a call spread on top, selling a put spread on the bottom. That is to open. Okay. Selling to open. We receive a net credit to enter the trade. And what we want that stock to do is stay between the two break evens, a break even of the call spread and the break even on the downside of the put spread. And that is how we profit. I'll talk a little bit more about this strategy as we go along, but let's jump into the list and start talking about this week. All right. And you're going to see a lot of familiar names, especially on the retailers. Okay. So we're going to jump over to the charts and let's start talking with Baidu. Okay. Now, Baidu, they declared this morning. Now, why would I want to show this? Well, this appears on our quiet list. Okay. Baidu currently down 83 basis points. So they didn't declare on Thursday. They actually declared this morning. So let me modify that. That is Monday, 5/18, before market open. The average move on Baidu is around 6%, but you can see here that it gapped up on the open and now it's trading a little lower and around 83 basis points. So nice, quiet stock. Now, this is really ideal. This is a $136 stock right now. Any stock that's usually $40 to $50 and above, up to about $600, I would say, these are great candidates. Okay. Especially these stocks that are in the $100 to $200 to $300 range, great candidates for our quiet strategy if they meet the quiet criteria. Again, that quiet criteria is average move less than 10%, so single digits around their earnings event. Okay. So we get into the real retailers really tomorrow when Home Depot announces. They will announce earnings results tomorrow morning. That's Tuesday, May 19th, before market open. And the move here is only about 3%. Okay. So it is a nice, quiet stock. And you can see this is a $300 stock. Usually we can get our trade off and put our break evens about 7-8% away. Gives us a little wiggle room. 7%, 8% above the price, 8%, 7 or 8% below the price. That gives us a little wiggle room, and that is really ideal. Now, here's the thing. The stock has been moving. As you can see, it's gone from $350 down to $300 in about a month. While I'm not really worried about that move for earnings, it's holding the trade after the earnings announcement. We get an implied volatility crush. That's when we make our money, but there's still some time value that we like to stay in the trade and allow it to expire worthless at the end of the period. And that way we receive the entire credit. Okay. So with it having earnings on Tuesday, there's several days of a hold period usually. And we like to eliminate that as much as possible. So usually Wednesday, Thursday trades are, earnings events are great because then I only have to hold these for a couple of days before maybe a Friday expiration. But Home Depot, average move 3%, still a great trade. We've actually had a lot of success with Home Depot over the years. All right. Now, another one on our list that's been a big mover outside of earnings is Analog Devices. Now, they will declare tomorrow morning as well. They announced before market open. The average move here is just 5%. Now, I put on these markers here for the last earnings events, okay? And you can see here that the last earnings event, the stock barely moved, maybe 1%. Before that, you can see it gapped down on the open, rallied higher at the end. It might have been up 1.5%. So this is a classic non-mover, even though the stock over the past since April, which went from $300 to $420 in about a 6-week period, we're not really worried about a move like that through the earnings announcement. Okay. Again, I'm looking at, okay, what has it done over the past 5 days or so? All right. And that's what really matters. And what happens when we go into these earnings events, implied volatility rushes into the options. It makes the options more expensive. We like selling that premium on these quiet stocks, getting that volatility crush after the earnings announcement. Analog Devices, another one of those good candidates up here at $400, roughly $400 a share. All right. Moving on, we get into some of the consumer stocks that involve the home sector. We have Toll Brothers. Now, this is a higher end home builder. They will report Tuesday, the 19th of May after market close. Toll Brothers has an average expected move of about 3%. Okay. They just really don't move around earnings. And at $120, $28, around $130, again, another great candidate for these iron condors that we like to do. So Toll Brothers coming up on Tuesday after market close. That takes us into Wednesday. All right. And Wednesday we get Lowe's. All right. So we have both Home Depot and Lowe's in the same week as we always do. Okay. But Lowe's will declare on Wednesday, May 20th, before market open, meaning first thing in the morning. The average move here is about 4%. All right. So Lowe's is a great candidate, $221 a share, a good candidate to consider for selling premium ahead of that earnings announcement. Okay. Now we get into a retailer here with Target. Now, I left something on the chart for you here, which I want to talk about, but Target will declare Wednesday, May 20th before market open. And the average move here is about 8%. So the bracket that you see here, I did a trade for our readers, for our customers, last in March, okay, on target. And these the horizontal lines of this marker are my break evens. This is my upper break even up here at around 126. This is my lower break even of my trade down here around 101. When we put this on, the stock was trading somewhere around right here. Okay, Monday, March 2nd, it was trading at 112, and you can see the stock after earnings rallied up and it challenged the upper break even. But by expiration, which is the vertical bar right here, look where it was in the upper half of our break even zone. This is where we were allowed to let the whole trade, all legs, expire worthless. We kept the credit, 100% of the credit we got to keep. And that's an example of kind of an iron condor. You have the upper break even, the lower break even. You just want that stock to stay within that range. And look what it did afterwards. It stayed in that range until right here on May 17th. So we could have done another one even after earnings, even though implied volatility was lower. All right. But with Target, usually the options are priced accordingly. When they start expecting about an 8% move, that means you can put your break evens because option premium is more expensive, yet they can do it around 11, 12%. And that usually is ideal. All right. Now, moving on through the week, Wednesday also brings really the earnings announcement that everyone's looking forward to, and that is Nvidia. Now, believe it or not, Nvidia does appear on our quiet list. They will declare earnings on Wednesday, May 20th, not May 21st. Again, a little typo there, and I'll correct that. May 20th, after market close. So they do it Wednesday afternoon after the market close. But the average move here is only about 8%. Okay. And again, I'm not worried about this vertical move in the stock. I'm just worried about what the company will do right around that earnings event. You can see the last earnings event identified with this vertical line back here in February. Look, we just dropped a little bit. Okay. Actually, I think we had a good successful trade on this. The time before, you can see it's just no big gaps. Okay. The gaps actually occur outside of the earnings events. However, we're getting to a point where when the CEO speaks, traders are going to be listening very carefully. And if there's any indication of a slowdown in manufacturing, or the outlook isn't as rosy, you could see volatility kick up on Nvidia. So this is one where we might just sit on the sidelines and just observe, because it could move double digits through its earnings announcement. It hasn't in a while because it's been, like I said, a very quiet stock. Its average historical move is right around 8%, and we could still see that. Again, I'm not really worried about a double-digit move, but it could happen, especially if Jensen says, "Oh, we are ran into an issue or a slowdown or whatever." So traders will be listening very carefully for that. All right. Now we have another retail bellwether here declaring earnings on Thursday. That'll be Thursday, May 21st. Before market open is Walmart. Okay. Now Walmart, again, big retailer, currently trading around $132. The average expected move here is around 4%. And again, you can just look at the past earnings announcements, and right through the announcement, here's a little gap. Okay. But believe it or not, that was about a 3% move for Walmart. And just every cycle, yeah, it'll move just a little bit, but it's not double digits. It's not a 10% move. It's not a 12 or 15% move like some of our breakout stocks do. So selling an iron condor here is ideal. Selling options premium here is a good idea. And that happens on Thursday morning for Walmart. Moving on, two more to go here. Now, Deere, John Deere is an interesting one. They will declare on Thursday before market open. Again, that's Thursday, May 21st. John Deere has an estimated move of about 7%. They did gap higher last time. This was a move that would not have been successful with our strategy, but the move before that, that's a successful move right there. This one back here, that's a successful move, especially with the rally up afterwards. Okay, but here's the thing about John Deere, and they are facing a very big court case that could have major ramifications, not just for John Deere, but on auto manufacturers too. And that is a lawsuit about right of repair. There is software that is preventing farmers and ranchers from repairing their vehicles that they have purchased, forcing them to take them to John Deere dealers so they have a special tool or a code or a computer that they can access the systems and repair it. Okay. And a lot of these farmers and ranchers say, hey, no, this is my piece of equipment and I have the right to repair it on my own. And this has gone to higher courts. And if you know what's coming down in the auto industry from a bill that was actually signed a couple of years ago, that they tucked into a bill about your car deciding if you're fit to drive. Okay. Imagine you being in an emergency, like escaping a flood or some sort of emergency, and all of a sudden your car detects you, oh, you're not fit to drive because your heart rate's elevated or your eyes are dilated or whatever. And that's coming. That's coming. So this John Deere lawsuit, again, I don't know if anything will be in the cards for this earnings announcement, but it's definitely one to watch. Okay. Definitely one to watch in the future, not only this earnings cycle to see how their sales are, because there's a lot of backlash here on this, but also big ramifications for down the road on vehicles produced, I think, after 2027 and beyond. All right. Okay. Closing out the retail week here, we have Ross Stores. They will declare on Thursday, May 21st, after market close. The expected move here is about 6%. So these are some of the most ideal candidates for our strategy. There are others, TJX isn't on our list. It only has a move of about 3%. Okay. But these really are the cream of the crop ones just because of their stock prices and kind of where they are, what their options expiration cycles are, et cetera, and so on. So Ross Stores will be announcing those results. And again, we're not expecting anything double digit. We're expecting, again, 5, 6, 7%, somewhere right around in there. And that is the expected average move for a lot of these retailers. Okay. All right. So that is our list for this week for the quiet stocks. Now we transition over to everyone's favorite, the breakout stocks. And these are the stocks that get everybody's attention because of their big double-digit moves. And you see them earning surprises or earning disappointment, and the stock moves 15%. Okay. That can happen with these stocks. All right. And some of them might surprise you. Okay. For example, maybe e.l.f., which is a beauty supply company. They're on our list. All right. Retailer Deckers is on our list. So let's jump into these and take a look. And we're going to begin with Agilicis. Now, you might not be familiar with this company, but they will declare earnings today, Monday, May 18th, after market close. The average expected move here is about 18%. Now, I priced this out right before we came on air today, and it's pricing in for about a 19% move. So it's right in line with kind of historical expectations. For these breakout stocks, we like to do straddles and strangles. Okay, where we buy a call and a put at the same strike for a straddle, or a call and a put with two different strikes, one strike for the call, one strike for the put, same expiration date. Okay, that's a strangle at different strike prices. Okay, now what we like to look for is mispricing in relation to the historical average move. When we get a stock like this that hey, we think this thing is going to move 18 to 20%. Well, it's priced for that move right now. However, if I was to price it out, and there's a method for pricing, you look at the pricing of the options, and it'll tell you what the options market is anticipating. If it was pricing at 12%, that would be an opportunity because somebody's not really expecting the big move, but all of a sudden it moves its historical average and boom, we make money. And believe it or not, that happens on a regular basis. Okay. You can see what the stock has done in the past. I mean, these big gaps around the earnings announcements. So that is why it's on our list. I mean, this thing's a mover. Okay. Around. So it's definitely one to watch. But right now, for as far as an opportunity goes, it's a little challenging because the options are pricing in that expected move that matches its historical average. Okay. Now, one that I did want to mention here is Snowflake. Now, they're getting a little bit of news today. They actually have earnings next week. Okay. We let this one get through. There were two different reporting services that had it for this week, but it's confirmed for next week. So we will be talking about this stock next week. But they're going to be on, guess what list they're going to be on? They're going to be on our breakout list next week. So watch out for Snowflake. That'll be next week. Okay. Now, with that said, here's a strategy. You can check implied volatility. And if it hasn't risen yet or begun to rise, and it's not at its historical average of implied volatility, this would be a good time to enter a straddle or strangle, okay? Because option prices are going to be a little less expensive, and you could kind of get a deal now on a straddle or strangle going into next week's earnings, okay? So you just want to make sure your expiration cycle is for a week from Friday or beyond, okay? And that is why I left it here. Even though they have earnings next week, that is a strategy that we deploy, is riding that implied volatility rush into the earnings announcement. And sometimes implied volatility rushes in so much, so hard, and inflates the prices that we can make a profit on our trade even before the earnings announcement and even with no movement in the underlying stock. Okay. Now, Snowflake doesn't sit still very often, okay? It kind of moves around. So the chances are that it will move, and we could see a profit before next week's earnings. So that's why I left it in here, but this thing's a mover around earnings, and it will definitely be one to watch. But yeah, go ahead and take a look at it now. Now, another retailer, actually, we got three retailers coming up here. Urban Outfitters, all right? Believe it or not, this retailer has an average move of around 15% through earnings. Now, this doesn't happen every single time. You can see the last earnings event. That's not a 15% move. Okay. But this is a 2-day event here where he rallied up on the day of earnings and then gapped up even higher. That's about a 13% move in total. Okay. There. And then big drop down here on that last earnings event. I mean, gapping around this stock here back in May of last year, okay, opened up around $59, closed the next day up at $73. So from $59 to $73, boom, take your money and run, okay? This average move of about 15%, we often see some mispricing here where you can get in a straddle or strangle and expect maybe a 10 or 11% move. And then it moves even bigger, and that's where we make our money. Okay, so Urban Outfitters, Wednesday, May 20th, aftermarket close. Average historical move here is 15%. Now, believe it or not, e.l.f. Beauty, eyes, lips, and face. Okay, interesting story about the former CEO. You can look that up about him. Nothing bad, but just interesting. Very interesting. But e.l.f. will have earnings Wednesday, May 20th, after market close, and the average move here is about 18%. Now, you see last earnings event here, stock actually gapped up higher and then whipsawed down, opened up here at $92, closed at $76. We would like to see this go one direction, not this whipsaw reversal, not gap higher and then close lower. We want a gap higher, close higher, even higher, or gap lower, close even lower. Those single moves like this, okay? Gap down on that previous earnings, closed even lower. That's beautiful. That's a big money maker right there. Okay. And this happens regularly with e.l.f. Here's a gap down, but then it quickly reversed. All right. So you got to watch these sometimes. And here's another one, gap higher, did rally up, way up, and then kind of came back down a little bit, but definitely gaps around its earnings, has a history of doing so. This is a $55 stock. So this is a great stock to trade. Again, using a straddle or strangle. Again, like you'd use a 55 straddle where you buy the 55 strike call, buy the 55 strike put with the same expiration. And you're looking for a big move either direction. And it just needs to move more than your break evens because you're going to have an upper break even and a lower break even. And that is the situation. But e.l.f. is a great one. Okay. Deckers, also a big potential of movers. They're now called, this was known as Deckers Outdoors. They're now Deckers brand because of some acquisitions they've made in the past. They will declare on Thursday, May 21st, after market close. All right. The average expected move here is 16%. And Deckers is a mover. Okay. You can see through these earnings events, every vertical line is a earnings event here, and you can see just lots of volatility around these earnings event. Okay. Here's a good example of you make money on your call, and you just leave the untested option alone. This thing reversed over the next few days, and even our put could have made money. Both our call and put could have made money. Okay, usually just one side of the trade makes all the money. Okay. Sometimes you get these wild reversals and both can make money if you're quick. Okay. But again, anyway, Deckers will declare on Thursday, May 21st after market close. Lastly, we have Zoom Communications. Now, Zoom isn't really as volatile as they used to be. They have an average expected move creeping down to about 11%. They will declare Thursday, May 21st after market close as well. And again, their average expected move is right around 11%. If you can't get into your straddle or strangle expecting about a 8 or 9% move, I wouldn't bother because implied vol or the move, even though it's gapping, it's not a gapping the way it used to. Okay, but you can see it still does. It still moves around a bit, but pricing is very important here. Okay, where your pricing comes in on your straddle or your strangle. All right. Okay, so that is our list for this week. What we do is we take the best opportunities from both the quiet candidates and the breakout candidates, and that's why we've shortened our list. Our eyes are on about 27 stocks this week. So we have over 226 companies declaring earnings this week, and we're only looking at about 27 of them. And of those, I condensed them down to our list here, and that's what you're seeing. And that's why we talk about these each and every week, because these are some of the best opportunities each and every week. All right, before we go, I want to talk about last week's trade, and also I got a new trade for you. So let's take a look. We did an iron condor last week on Alibaba. All right. And again, this is what the risk graph looks like. Okay. When you model out the option trade, so you see the stock chart on your left, you see the risk graph on the right. Okay. And as long as it stays within that rectangle, all right, that's where we make money. All right. Stays between those break evens. There's an upper break even and a lower break even identified by that horizontal dotted line. And as long as it stays in between there, we make money. So we sell it as a credit. We receive that money. All right. The risk in the position is margin, and we just want to hold on to it. So how did this trade do? Well, this trade did exactly what we wanted to happen. Okay. Alibaba, it moved just a little bit, maybe 1% or so. And the trade was very successful. We sat in it for about 2 more days. We held on it through expiration and ended up with a just under a 40% return for 3 days in a trade. Okay. That's one thing about these iron condors. We don't stay in them very long. All right. So we were in it for 3 days. got a 38.8% return on our risk. And that $140, again, that doesn't seem like much, but what I'm doing is I'm pricing these out based upon a $10,000 trading account. So, if I did one or two of these, all right, that's what the trade and in this case, I did one, okay, one contract up and down. All right. That generated a 1.4% return on portfolio in just 3 days. So when you start doing these over and over again, you can have 3%, 4%, 5% months returns added to your overall performance. You annualize that out, and you're talking 35 to 65 to 70% return on portfolio just for sitting in a trade for 3 days and doing it over and over and over again. Okay. And we've done a lot of these this year, and we've been very successful at them. All right. So what do I have for you this week? Well, we're going to stick to our guns and do another iron condor here. As much as I like these retailers that break out, and I was very close to doing one of those, I went ahead and went with Walmart. Okay. So we're doing an iron condor with Walmart. I'll tell you, the strikes are just $2 wide. Okay. So the call spread is $2 wide on top. The put spread is $2 wide on the bottom. We account for a movement. You can see where the break evens are in relation to price. So you see, we have a lot of wiggle room there. All right. And we're just expecting Walmart to just do what it does through that earnings announcement, just move no more than 3%, either higher or lower, and stay right in between those strikes, and we can then profit. But we will have the results of our trade next week for you right here, and we'll tell you exactly how we did on it, whether it's a profit, whether it's a loss. We manage every single trade. All right. So that's our list for this week. Listen, I hope you got something out of our show. It's a big week with Nvidia and all the retailers. And next Monday is a holiday here in the U.S. It is Memorial Day. So we will take the day off and probably be with you on Tuesday. But everybody enjoy the holiday weekend this weekend, and everyone have a great trading week, and I will talk to you again soon. Everyone take care.